Okay. Morning, ladies and gentlemen, and welcome to the third annual Market Practitioners Group Conference. My name is Delisile Mthweni, and I will be your program director for today. So that means I have the easiest job of anyone here today. But in all seriousness, I'm honored to be honoring such an amazing event, and thank you for making the time to attend this conference. And I really do hope that you find the upcoming panels as well as the presentations we have to be quite insightful, and that you gain valuable information from it. So the theme this year is the JIBAR transition, navigating through the risks and opportunities, and this has indeed been a journey. Am I audible? Am I still audible? Okay. So yes, we hope that this year's conference will really help with unpacking key developments as well as the upcoming milestones of this transition, as well as aiding the various organizations here today in their seamless preparation for the adoption of Zeronia. So let us now into the housekeeping rules ahead of today. So on your tables, you should find a booklet, and this basically contains the conference agenda as well as bios for the speakers that we have today. During the Q&A, it's requested that can you please use the mics on your table and speak into the mic. So please just unmute accordingly. The bathrooms of the venue, so if you head straight out to your far left, that's where the bathrooms are located. In the case of an emergency, the emergency exits are clearly marked, so please follow those in the unlikely event of an emergency. We kindly request that all cell phones please be put on do not disturb, or please switch off your cell phones just so we don't interrupt anyone that is speaking. The venue does provide Wi-Fi. The Wi-Fi name is guest at Maslow, and there is no password for the Wi-Fi. And then, should anyone want to post about the event on their social media platforms, we kindly ask that you use the hashtags MPG Conference 2024 or hashtag Zeronia in your captions. And then on your tables, we have also placed a little thank you gift as a token of our appreciation for your attendance and participation today. So in the spirit of sustainability and doing our part for the environment, we have gifted you these glass bottles that are filled with water. So please feel free to use them throughout the day and make sure you actually leave with your gift. Okay, so moving on to the agenda. So the agenda is located on page 3 of the booklet, so I won't be going through all of that. However, please note that during the second coffee break at around 2:30, we will be having 2 sessions that will run concurrently. So the first session will be on operational readiness and infrastructure modernization, and that panel discussion will take place in this boardroom. And then the second session will be a technical discussion on the derivatives market, and that will happen in the Zenith boardroom, which is across the hall. And we will end the day with refreshment and an opportunity for attendees to network. So please choose us and our cocktails over the rush hour Sandton traffic. So now that that is out of the way, we will be moving into the keynote address. So yes, the keynote address will be given by the MPG chairperson, Dr. Rashad Kassim, who is also the Deputy Governor of the South African Reserve Bank, as well as a member of the MPC. He oversees the market, the financial market and international cluster, which is responsible for financial markets, international economic relations and policy, as well as legal services and the national payment system. So, ladies and gentlemen, may we please welcome DG Rashad.
Thank you very much, Delisile. It's quite striking. I think the last time I was in this room was we had one of our monetary policy reviews where we discuss monetary policy. And what's interesting about monetary policy is that it's the interest rate that has an impact on your loans, bonds, and so on. And the larger public can identify with it. But when you talk about benchmark interest rates and all these short-term interest rates, it's a very small, narrow world of people who understand this world. It has implications for monetary policy, but I'm sure that we all a very select group of people who understand this kind of world of interbank rates and JIBAR and so on. How to kind of make this a more intuitive concept is often difficult. Having been on the Monetary Policy Committee forever, just trying to understand the relationship between the interbank rate and the greater economy is itself complicated. So I have a written speech. If you find something remotely interested in it for reference, it will be on the website later today. Before I get to it, I'll also say that I was quite struck as someone who came from a different part of the SARB as an economist at all the resources you have to harness for something like this, the legal teams, the infrastructural teams, the technology. It's incredible how complicated these things are, but I've been so impressed with the expertise in the country, the knowledge to do something, to pull off something like this, which at first glance may sound very esoteric, but is really critical to the sustainability of the financial sector and as well as the economy as a whole. So thank you everyone for being here. I know it's very convenient, as I saw a number of people who work in the center area walk to this place. Sorry about those who live in Pretoria. I live in Rosebank, so that's easy for me too. So as you know, the main topic today is the transition from JIBAR to Zeronia. We have been at it, and under the leadership of Zafar Bafundi and Zakele, this predates me taking responsibility for this area. So we're working on it for several years in building the foundation of the reference rate reform. So the designated successor to JIBAR, Zeronia, as you all know, is an overnight wholesale deposit rate. It's a near risk-free rate, and unlike JIBAR, as many of you know from our deliberations, is based on large volumes of actual transactions in the South African market, as opposed to a rate based on small volumes of quotas. Now, the veracity of Zeronia has been tested extensively through a year-long observation period, which concluded in November 2023. It is now being published daily on the SARB website for use in financial contracts. Many of you know, as I outlined, there's a whole industry that has gone along with this transition process, and we've published several white papers recommending market conventions for the Zeronia-based cash and derivative products. Based on these developments, market infrastructure providers have implemented solutions to support market activity. Before we go to the more interesting parts of the discussion, like the panels, I want to make 3 general points and then just highlight a few operational and methodological challenges associated with the transition process. Needless to say, the SARB remains committed to discontinuing JIBAR. Second, it is important for market participants to prioritize an active transition away from JIBAR-based contracts and not just adopt a wait-and-see attitude. The best way to minimize transition risks is to minimize the stock of legacy contract based on JIBAR. The most progressive way or constructive way forward for market participants will be to take ownership of this transition and to establish transition programs within your organizations and to work out your own paths forward. Now, a quick point on JIBAR cessation. The latest results from the JIBAR-related exposure survey indicate that a number of financial contracts referencing JIBAR remains huge, with the total gross exposure estimated at over 57 trillion rand. How many times our GDP, I can't count at this stage, but much of this exposure is attributable to the derivatives contracts that reference the 3-month JIBAR, accounting for about 91%, while at the same time, the volume of 3-month negotiable certificate of deposits that underpins the 3-month JIBAR remains very small at just 10 billion rand. We clearly need a benchmark, and that is why we committed to the JIBAR cessation. That said, the SARB's commitment to discontinuing JIBAR should not be taken to mean that JIBAR is non-representative. It is not the SARB's intention to trigger any pre-cessation clauses at this stage, but rather to give the market the confidence it needs to engage with the transition effort in earnest. The MPG's recent update on the JIBAR transition plan indicates that JIBAR will cease towards the end of 2026. The SARB intends to announce a precise JIBAR cessation date in December 2025. This really leaves the market just over 2 years to complete the JIBAR transition. It is an ambitious timeline, but achievable. Now, you all know that JIBAR and Zeronia are structurally different. There are term and risk premia in JIBAR that do not apply to an overnight cash rate like Zeronia. Therefore, we will need quantitative techniques to achieve economic equivalence when switching from JIBAR to Zeronia. This will largely be achieved by adding an adjustment spread to Zeronia. Now, you may ask, how can we determine an appropriate adjustment spread? And as the chair of the MPG and someone who's a step removed from the minutiae of debates, I've been very, very fascinated at the detail and the analytical ability that you have to demonstrate in going into these little discussions that have significant implications for the interest rate landscape in South Africa. So, an adjustment spread is not a straightforward question to answer how we determine it. We could employ quantitative models to identify the various premiums in JIBAR and then base the adjustment factor on these spreads. However, model results can be sensitive to assumptions, and the models themselves may not be widely understood, which could make it difficult to achieve consensus on what the appropriate adjustment spread should be. Alternatively, we could rely solely on observed data to compute the adjustment spread. This would require choosing an approach, for instance, the historical mean or median, the spot spread, or the forward-looking approach. This would then inform the choice of the Zeronia measure that will be used. That is, whether the adjustment spread incorporates compounded Zeronia period averages, spot Zeronia rates, or forward-looking Zeronia rates that incorporate market expectations. Clearly, the choice of the JIBAR measure would need to align with the choice of the Zeronia measure. Now, in many of these things, we're not alone, and fortunately, there's the International Swaps and Derivatives Associate, ISDA, which is a kind of a standard-setting, rule-set body, has consulted widely on this issue and concluded that market participants would prefer the historical median approach with an adjustment spread based on 5 years of data. This method would be robust against data outliers resulting from unusual market conditions as well as potential manipulation. Consequently, this method was adopted in cash and derivative markets in the United States, United Kingdom, and many jurisdictions that were impacted by the London interbank offered rate LIBOR transition. Nonetheless, in South Africa, market participants are not only concerned about dealing with data outliers, they're also concerned about structural shifts in the behavior of JIBAR, especially since SARB's migration to a surplus system for implementing monetary policy in June 2022. And this is something that has come up quite a bit in our discussions as we move to a fundamentally different monetary policy implementation system, from a scarce system to a surplus system. It appears that this reform has squeezed, this system has squeezed liquidity premiums, in that the spread between Zeronia and JIBAR has narrowed somewhat. The MPG is currently finalizing its work on the adjustment speed methodology to ensure that chosen methodology considers all idiosyncratic factors that would concern market participants. It is also important for market participants not to over-rely on fallbacks to facilitate legacy JIBAR referencing contracts. The best way to minimize risks would be to actively migrate to Zeronia referencing contracts as soon as is practicable. There will nonetheless be instances where, despite best efforts, it may not be possible to transition or adjust certain contracts before JIBAR ceases. These so-called tough legacy contracts will require regulatory measures to facilitate their transition. As such, it may be necessary for the MPG to consider a synthetic JIBAR, similar in structure to the current forward-looking JIBAR, to minimize the impact on systems and processes. Furthermore, the MPG, the SARB, and the Financial Sector Conduct Authority will consult with National Treasury on the appropriate regulatory instruments for ensuring contract continuity and safe harbor provisions for the protection of contract parties, supervisors, and benchmark administrators. Now I can see from the faces everyone's getting bored, so I try to speed up and get done. Shortly after the MPG conference in April 2023, the remaining US dollar LIBOR panels were discontinued. This concluded a massive, decade-long global project to replace LIBOR. Reflecting on this effort were co-chairs of the Financial Stability Board's Official Steering Committee, Nikhil Rathi and John Williams, concluded that it's been like building a new foundation under an existing home. And I can't think of a better analogy, building a new foundation under an existing home. An undertaking of an extreme difficulty, one many doubted would succeed and which they did not wish to repeat. It is remarkable that we have had largely a smooth LIBOR transition, and local institutions should be commended for managing their LIBOR exposures effectively. However, in South Africa, we are not yet at this stage where we can really take it easy and relax and enjoy our new foundation and promise ourselves that we've never want to renovate again. We are only embarking on a critical stage of the JIBAR transition roadmap, which requires market participants to start trading Zeronia-based securities in earnest. A poorly coordinated transition or a delayed action by market participants could result in market disruption and undesirable cliff effects. Consequently, market participants should consider a smooth JIBAR transition as a strategic priority both for their own organizations and the larger financial system. Last year, I asked market participants to consider elevating the JIBAR transition discourse in their organizations and to establish transition programs with visibility at the executive board level. This work is even more urgent today. Let me conclude by saying that global reference rates were triggered by serious weaknesses in existing benchmarks. These included failings, glaring cases of market design failings, glaring cases of market manipulation, and structural shifts in the markets underpinning benchmarks. The responsible authorities had no choice but to reform. But reference rate transitions cannot succeed if market participants do not join in the journey. I hope you look at the transition not as a chore or a burden to be taken on with great reluctance, but as an opportunity to build better markets as we navigate together to a new benchmark. There are uncertainties contained in the JIBAR transition plan. None of the listed milestones and timeliness are cast in stone, At best, they reflect the MPG's best estimates given the knowledge and information at hand. It is possible that some milestones may need to be shifted now and again. We would not like to do that, but we have to be practical. Nonetheless, the MPG will endeavor to manage the uncertainties and continue to engage all stakeholders to provide clarity where necessary. This is the end of the boring part, and now we get to the panel discussions, and I look forward to listening to the panels, and thank you everyone for attending. Thank you very much.
Thank you, DG, for those insightful notes. And please note that the keynote address is available on the website for those who are interested. So as the DG mentioned, it's time now for our first panel discussion, and this will be on reference rate reforms as well as the emerging opportunities set. This discussion will unpack critical milestones as well as the JIBAR transition roadmap, as well as highlighting opportunities and challenges that market participants need to consider. So this session will be moderated by Zakhele Gininda, who is the lead financial market specialist within the Market Operations and Analysis Division in the SARB's Financial Markets Department. So please note that there is a short bio on each of today's speakers within your booklets. So over to you, Zakhele, and the panelists.
Are you happy? No, your boss can sit here.
You sit there.
Good morning, everyone. Thank you for making it today. This is such a great turnout, so we feel really, really grateful for everyone who's made it this morning. The first panel is made up of MPG members. We thought that it would be best for them to answer whilst everyone is still fresh in the morning, and so you can pose your questions directly to them. This is not the whole MPG, of course. Some of the MPG members are sitting right here in front, so you don't have to worry if some of these members cannot answer. We will redirect that question to the relevant person. I see Mulileki sitting there, who chairs the legal work stream. I'm sure Kumra is somewhere elsewhere. He leads the accounting and tax work stream. And so if you've got questions to that, and the chair of the data collection and infrastructure work stream, Mr. Rui, is right there as well. But in terms of the people that are on the stage, I will do just a brief introduction. On my left is Jill. She is the Senior Policy Advisor at ASISA, and she is the member of the MPG, but she also sits in different work stream. Today she will represent not only the buy side, but also the cash market work stream. Next to her is Almarie. She is the head of financial benchmarks and credit rating services at the FSCA. She chairs the governance and regulatory issues work stream. And then we have Richard, who is the interim group treasurer at ABSA. He chairs the derivatives work stream. And finally, we have Mr. Parker, sorry. Obviously, Mr. Parker is sitting next to Elmarie. He is the head of the Financial Markets Department at the SARB, but he also chairs the communication and educational outreach work stream. So the DG has said quite a bit in terms of the JIBAR transition, but if anything, we all appreciate that it represents a significant change in the financial markets landscape, and this is because Elmarie would refer to it as a critical interest rate benchmark. JIBAR is deeply embedded in the financial system. It is used to price and value financial instruments, transform assets and liabilities in balance sheets, and speculate obviously on interest rate dynamics, as the DG was mentioning, its relevance for monetary policy, and also to manage interest rate risk. In some cases, JIBAR it actually forms quite an integral part of the core business model of some financial institutions. And so, because of that, it is widely referenced in financial contracts and finance expression in various systems and processes of market infrastructure providers. We wanted to just give you a sense of JIBAR-related exposures so that you can appreciate why this transition is going to be a challenging one. And I will ask Nawid just to maybe help me move the slides. The DG has already pointed out, sorry, DG is Deputy Governor. We use that at the SAP. So the Deputy Governor, Dr. Rashad Kasim, has already pointed out that the total exposure that we've estimated using responses from commercial banks and also some insurance companies, we estimated it at about 57 trillion. Breaking that down, assets and liabilities make about 7% of that. So assets at about 2.3 trillion and liabilities about 2 trillion, and derivatives making the remainder of that, which is about 93%. He's mentioned already that the 3-month JIBAR accounts for most of that derivative exposure, but sorry, are the slides even moving? Maybe let me see if I...
Yeah, they are.
Okay. Sorry, Nawid, if you can just put up the correct slide. Okay. In any case, out of all the derivatives, the 3-month JIBAR accounts for about 99% of those total exposures. Now, in terms of the maturity profile, we know that about 77 of those total exposures will mature within 2 years, and the remaining 81% will mature in 3 years. And so when the DG says that the JIBAR transition is achievable, partly it's because we've looked at these numbers and that you should be able to retire some of these contracts if we're to actively transition out of them within that period. And then you will have obviously a remaining stock of legacy JIBAR contracts that you would need to deal with, and hopefully those will just be the tough legacy contracts. But I thought what was interesting in terms of those assets that we were mentioning, sitting at about 2.3 trillion, is that there's about 82 contracts that actually facilitate those products. But out of that, about 52,000 of those actually relate to retail mortgages, even though that they account for about 29 billion, which is a very small amount. And obviously, if we think about the retail sector, we need to be very careful in how we manage the transition. So I'll now turn to the panel, now that you have a sense of how big the challenge is and what it means to build a foundation in an existing structure. I will ask the panel members questions first, just to give them an opportunity to settle down and to answer from what they've prepared for you. And then I will open it up to the floor to ask them whatever question that you might have. We'll close the session by giving them an opportunity just to, if they've got any closing remarks or thoughts that they might just want to leave the audience with. And maybe we'll start with you, Mr. Parker. ZARONIA has been designated as the MPG's preferred rate that should replace JIBAR. Perhaps for those that may be hearing about Zaronia for the first time, could you maybe touch on what Zaronia really is, and then maybe what are those key developments that came about since the last conference?
Okay, thank you, Zakele. Just for the record, Zakele doesn't call me Mr. Parker at work, so I'm not sure what's happening. I don't know if it's because the deputy governor, because we also just say Rashad and that's it. So this notion of Mr. Parker, DG, and so on. For the record, we are not that formal anymore at the South African Reserve Bank. And I'm glad that you actually asked me to explain to a novice, because I'm certainly not as technically astute or equipped to answer all the technical questions. The technical experts actually sit right in front of me. But for the novice, yes, the Zaronia is, for those that don't know, is short, and it's quite a tongue twister. It's the South African Rand overnight index average rate. It's a risk-free or near risk-free rate, which the SARB publishes, well, calculates and then publishes. We say it's a risk-free, near risk-free rate because it's based on wholesale unsecured overnight deposit rates placed with commercial banks. So we assume that credit risk is minimal, but not necessarily absent. Now, the rate is calculated, again, a tongue twister here, the rate calculated is a trimmed volume weighted average rate of all qualifying deposits that exceed over 20 million Rand. So just to put it into perspective, this year, the total value of the daily transactions that is used to calculate Zaronia averaged 432 billion Rand per day. So that's a 10% increase from last year's value. So what we're saying is that Zaronia is underpinned by a deep market, which makes the benchmark robust. This contrasts sharply with volumes that underpin the determination of JIBAR, especially for the 3-month tenor, something that Rashad attended to in his, alluded to in his opening remarks. I can't say Rashad because he's not in the, otherwise I'd have said Deputy Governor. No, I'm just joking. So Zaronia remains stable since the last MPG, and we spoke about its stability at the last conference, and we observed, at the bank, we observed that the rate was indeed responsive to the SARB's policy rate. Now, there's not been any rate hike since the last MPG conference, but we are comfortable that the rate continues to be highly responsible for repo rate changes. So just a little bit background of other things that are happening in terms of Zaronia. So the SARB has collected historical transaction data from all reporting institutions in order to calculate and make available Zaronia rates spanning, proxy Zaronia rates spanning from January 2016. Now, we understand that market participants would like to have access to proxy rates to gain a better understanding of the historical Zaronia. And so the data has been made available for research and analytical purposes. And an example would be for the determination of credit adjustment spreads. It's also enabled certain market infrastructure providers to ready the processes and systems for Zaronia, especially with regard to referencing derivatives. The SARB will post proxy rates publicly on the Zaronia webpage in the near future. The South African Reserve Bank has also began publishing a backward-looking compounded Zaronia index and period adjusted averages. What we've noticed over the last couple of months is that we've received quite a few requests or several requests from market participants to offer a Zaronia calculator with options for selecting observation shifts and so forth. Now, at the bank, we will look into these requests and see if it be feasible for the SARB to develop such tools. So let me end it there, Zakele. Thanks.
Thank you, Zafar. This idea of compounded Zaronia seems to be an essential one for the MPG. If we look at the market conventions that have been recommended for the cash market and also the derivatives market, they use this compounded backward-looking Zaronia. But at the same time, the MPG has been talking about the importance of creating a forward-looking term rate that performs the same way, or that does what JIBAR does in terms of being able to tell you what rate it will pay in 3 months, 9 months, or even 12 months ahead. Now, because of that, some market participants will be waiting for a forward-looking term rate to transition instead of transitioning to Zaronia. And this I will pose it to you, Jill, since you represent the cash market work stream today. And it's the cash market work stream that is looking at this issue of a forward-looking term rate. What is the possibility of developing a forward-looking term rate before JIBAR is discontinued? And how is the MPG or that work stream thinking about how it will be used?
Okay, so I think what we need to understand is that in the last 6 years that we've been working on this project, we've got a whole lot of new terminology that we, as the Zaronia groupies, have got used to. So the idea of a cumulative compound interest rate fixed in arrears is sort of our mantra. But if you think back to the basics of interest, discounts are in advance, interest is in arrears. But with JIBAR, we know what it is in advance, even if it's paid in arrears. But now we're going to be paying in arrears on something which will be known either 5 days before interest payment date in the bond and loan market, or 1 day in the case of money market. And that creates some logistical problems. So ideally, we would like to have, continuation of status quo, where you know what the rate is in advance, but unfortunately, we need to look at what the options are. Option number 1 would be to look at the term deposit rates. So if you go back to 2018, the first consultation paper, the indication was that there was significant volume in term fixed and floating rate deposits, and that this was a possible contender for to be a reference rate. Then in 2020, and that was using 2015 data, then there was a further study which was published in November 2021, which indicated that actually the volumes in these non-bank financial corporation fixed and floating deposits were not as large as we had previously thought, and that it was not going to be able to create a rate that would be IOSCO compliant based on term deposit rates. However, we continue to collect this data, and this is ongoing monitoring. A second candidate would be the T-bill rate. The T-bill rate, unfortunately, we have new set of 4 T-bills every week, and we have limited secondary market, so it's relatively illiquid, and it's very difficult to collect a good set of data to create a benchmark. Then we move into the derivatives market, and once again, we've got some very neat terminology. We used to have swaps and FRAs. Now we've got OIS swaps and forward start single period OIS swaps, which is the new word for FRAs. So we need to be able to collect this data in a trade repository, and we would have to build up deep and liquid markets in these derivatives in order to be able to support a cash market. So the actual trading is only scheduled to take place in volume beginning of next year. I think we also have a situation where a significant portion of trade in interest rate swaps is cleared through LCH. So that it's matter of collecting the data from LCH as well as collecting the South African data in a trade repository within South Africa, and then using this data to generate a forward-looking rate. So how long is it going to take to build up this liquidity? If anybody can answer that, please assist. Somebody did ask me when the original swap market started and how long it took to build up liquidity, and that was AJ, and I did tell him it was 1988, but I can't remember how long it took to actually build up the liquidity that we currently have. So we don't know how long it's going to take. So I think it will be several years, realistically, before we will have a robust forward-looking term rate based on derivatives. So what do we do in the meantime?
Well, Richard believes we can build liquidity by end of next year. Is that not so?
We'll pass that on to the audience. No, but obviously, I think we're pushing, as all the work streams are, to come up with innovative ways, trying to get as much encouragement as possible to all the market makers to show prices, to demonstrate the willingness and ability to trade, getting the infrastructure in place. And the sooner that all comes on board, the sooner we start to see volume and transactions happening.
Sure. And maybe if we can come back to then the term rate that might potentially be developed using some of the data that we may collect from this future trade repository. And there will be a work stream that talks about some of the planned infrastructure modernization and opportunities, including the establishment of a trade repository later on in the afternoon. But suppose that that is established, we're able to collect, we're able to calculate based on whatever formula you would have prescribed as a cash market work stream. What sort of limitation would you put on that term rate then in the meantime whilst you're waiting for that robust sort of term rate to develop, which may take many, many years from now?
So I think you'd have to identify which particular parts of the market need a forward-looking rate for reasons that we will come to, the National Credit Act, retail products, trade finance, and invoicing, trade finance and supply chain invoicing. So it would be limited use, because if we allow, well, if we don't restrict it, then you're going to have competing pools for liquidity. And ideally, we want to move to a robust Zaronia framework. So it would be a transition process.
Sure. And then I suppose this is what the authorities or the official sector refers to an inverted pyramid, that we want to avoid having instead of that inverted pyramid. And so we need to allow the market to develop and make sure that there's enough transaction or that the market is deep enough before you have you build a term rate that can be relied on and used as the critical reference rate. Maybe Elmarie, if we can come to you, the DG mentioned something about squeezing a squeeze in the liquidity premium that has resulted in the narrowing of the spread between JIBAR and Zaronia. If I held floating rate notes or sectorized syndicated loan, and I don't, I'm a public servant, I would be worried that what would be getting squeezed is me, because the banks, in a way, their pricing behavior determines both Zaronia and also JIBAR. And so this leads to this issue of information asymmetry that exists, and therefore to ensure that people trust the process and they trust these rates that are being published, especially if we're talking about managing or minimizing economic value transfer. How should market participants think about issues of treating customers fairly and maybe also issues of market conduct in terms of this JIBAR transition?
So treating customers fairly means that financial institutions should be responsible and accountable for the consequences of wrongdoing and poor decision making. Financial institutions should take appropriate and timely action to identify and rectify issues that relate to the unfair treatment of customers. Acting fairly towards customers requires financial institutions to act with ethical values, fair judgment, and professional diligence. Customers should be confident that the financial institution that they are dealing with recognize the fair treatment of customers as an essential part of the corporate culture, and that the representative of that entity are competent and have expertise in the products and services that they offer. So financial institutions should train their staff appropriately. They should document their decision-making processes during the transition, especially in relation to dates and the adjustment in methodologies. They should be transparent and appropriately share and communicate all necessary information to clients. They should present timely, clear, accurate, and comprehensive information to clients using language that is easy to understand. Financial institutions should discuss all relevant changes, for example, changes in term structure, frequency of payment, and the interest calculation. They should be upfront about actions that are required of clients during the transition process, including making changes to their systems to ensure that they are able to process overnight rates, and discuss and manage term rate expectations of clients. They should comprehensively and timely disclose the risk and impact on clients. The focus should be on ensuring that clients understand the impact of the JIBAR transition, the implications for their business, and various dependencies associated with the transition process. They should use their knowledge to help clients make decisions about the appropriateness of products and services and not take advantage of the potential lack of understanding of the transition process. They should ensure that new products and services that reference alternative reference rates are properly and objectively explained to clients, and that clients understand the differences between their products and the services which reference JIBAR and those that reference alternative reference rates. Then with regard to the management of conduct risk, an adequate risk management framework with appropriate governance is a fundamental step in managing conduct risk. The JIBAR transition's overall responsibility and accountability should be placed with the board and senior management. A centralized governance structure should efficiently allocate resources, including using relevant technology and analysis to generate useful information for decision makers. Policies and procedures should be informed by the risk identified in connection with JIBAR, the JIBAR transition, and should be detailed enough to address those risks. Consideration should be given to how this risk framework applies to the specific JIBAR transition-related conduct risk, and whether additional framework or a separate dedicated program should be implemented. Adequate records, like I said before, should be kept, which demonstrate that policies and procedures are being followed. And the framework should provide for conflict of interest to be appropriately identified and mitigated. For example, in relation to the value transfer that may result from contract transition, or where entities have discretion around the operation of contractual fallbacks.
All right, sure. I think everyone has had an opportunity now to at least answer one question. I would like to open it to the floor if there are any questions at this stage before we move to the next round of questions. Please use the mics on the table. It looks like the panel members have not said anything that is interesting as yet. Yes, please.
Just a quick one. Is it wise to use, say, the derivative market swaps and FRAs to generate their own fixings? So you'd be inferring the 3-month rate from, say, the FRA market, and then you use that same fixing rate as the fixings of the FRA market. It sounded a bit like a circular thing, which may, it just sounds like it could be open to abuse. What do you guys think about that?
And then I suppose you're referring to the determination of that
Yeah.
term rate.
Look, there's always an issue generating a cash instrument from a derivative. You know, we grew up in the world of start with cash and then write derivatives. Unfortunately, you know, sometimes it does have to be the other way around in order to have the forward-looking nature. So, you know, we've seen it with Sonia and with SOFA. They had the benefit of trading these overnight swaps. I think Sonia started in 2018, or I can't remember the dates, but you know, they were trading well in advance, which we don't have. We don't have an OIS market. I think we do have a contract for difference on the CEFIX overnight, but it's customized. So we don't have that pre-existing derivative market. So yeah, sometimes we do have to turn things upside down in order to generate the necessary information for, you know, for the products that are on offer. And sometimes one does not get too concerned about the third decimal. You know, we're looking for something which is a reflective of conditions in the money market. And if we need to rely on a deep and liquid derivatives market to generate that, that's what we'll have to use. And I think we're all fully aware of the, you know, the forwards and the FRAs are not a good indicator necessarily of where interest rates are going. We're not trying to indicate where interest rates are going. We're trying to generate in advance something that will allow borrowers to know what their what the interest payment will be in 1 month or 3 months' time. So it's a slightly different purpose. I hope that makes sense.
Thanks, Jill. Richard, would you like to add to that?
No? There we go. You know, Jill talks about building liquidity, and you asked the question earlier. And maybe just to add around how we're thinking about this from an MPG perspective. Because ultimately, the success of all of this is going to come down to how quickly we get trading going in this market, how quickly we get decent liquidity and volumes being traded on a daily basis. And I think how we've thought about it from an MPG perspective is to be as inclusive as possible and to be as broad as possible. So we've got banks involved, we've got asset managers involved, we've got infrastructure providers, we've got corporate representatives, etc. And all of that is just bringing everybody together to agree on the way forward in terms of this reform agenda. And what that means is that by having all those stakeholders involved in trying to get this market up and running, is your starting base is one of general agreement amongst all the market participants. And so we think that is the first step. The second step becomes one of having a regulator who supports this. And, you know, the DG or the Deputy Governor, you know, spoke about it this morning in terms of the involvement. And it's critical, right? It's critical in terms of putting in place credible timelines that the market believes and therefore adheres to and works towards. Because if you're not ready for it, ultimately it creates problems down the line. And you know, you're heading very quickly towards a wall without any safety measures in place. So, you know, things like Dear CEO letters, telling the CEOs of the banks that we are proceeding with this, we are doing it, we need to be ready as an industry, are critical. Having Zeronia First initiatives to say, you know, when we have these contracts in place, when you're pricing instruments in the market, quote Zeronia first before you quote JIBAR in that interim period. and it's critical. And I think, fortunately, we've had the experience of the offshore market to demonstrate how this can work and how critical the involvement is of the regulator. And maybe I'll elaborate a little bit on that. What I mean is, if you look at the US and the UK, what's happened in those markets? There was a clear difference in how the treatments and the regulator involvement was in those markets. In the UK, they created timelines. The governor of the Bank of England stood up and he said, there's agreement with the timelines. He also made the comment that these timelines are not going to change. And by making that clear and crisp, it forces all industry participants to get on board as quick as possible. They also made it clear that at what date LIBOR is going to fall away. And again, that gives clarity to the market. And as a result, what did we see? We saw SONIA developing a deep and liquid market very quickly, as opposed to the US, which took quite some time to build up liquidity and transactional volume in SOFA. So I just wanted to add those points, Akele, just to stress how we're thinking about this in terms of building liquidity, building a market which allows us to transition in a smooth way.
Thanks. So the way we position this transition is that it should be market-led, which means then that firms should transition on a voluntary basis. But as you mentioned, regulatory instruments and clarity from the regulator in terms of cessation date becomes quite critical. And not changing those dates provides the certainty required. But I'm quite interested in a market-led and voluntary-based sort of transition. How can we move markets to actually start transitioning and also maybe start using Zaronia and not necessarily wait for the Zaronia First initiative or the Dear CEO letters? So I won't put you just on the hotspot alone. There's a table here full of market practitioners who've been wondering about that problem. So you can call a friend from there to also assist in this. But it's quite critical because before these regulatory instruments come into force, you need to see the market moving by itself, on its own, being interested in the transition. Do you want to maybe start, and then we can see if that table has anything to say?
Yeah, happy to give them a bit of time to formulate their answer. No, I'm joking. Look, I think, as you say, it's really the industry driving this, right? And so some of the discussions we've had in the work streams revolve around, even if the market infrastructure is not ready to trade a particular type of instrument, let's not wait as a banking sector, for example, to go and put prices up on screen. So let's put up indicative prices for Zaronia-based instruments and say, look, these are indicative. They're not tradable at the moment until infrastructure is ready. But this is how we are thinking about pricing. And the more market participants see that up on screen, see pricing on a daily basis, the more it starts to build that muscle memory, the more it becomes clear. And I think just looking at the number of people here versus last year, it talks to how real this is becoming. And so the more we see it, the more it gets spoken about by a regulator, the more it gets spoken about by banks in interactions with clients, the more it is on investment roadshows to asset managers, to corporate names, the more it starts to build. And then the reference to what does screen pricing look like, etc. Are systems ready to trade? And the second we're ready from an infrastructure perspective, I know from a banking perspective, we are very keen to get that first trade on the book and then start to push that as much as possible.
Sure, Mr. Parker.
Yeah. So, if I can just add, I mean, I fully agree with what Richard says, and you know, all of us have been watching or had watched the transition in the overseas market in the US and the UK and Europe in particular. So there's always a fine balance between the regulators saying, this is the date and no more. That's what Andrew Bailey said, or at the time at the FCA, and the dear CEO letters going out to say, dear CEO, you will be ready by then. Versus the guys from the market infrastructure that say, we are not ready yet, our systems are not ready yet. But something is going to unfold now in September, which I know was also, you know, people were not ready. I'm not trying to build a similarity there, but we need to find the right balance. We almost want people to be, you know, on a voluntary basis, make sure the systems, the processes are ready. Obviously, there are things that are maybe not in so much in our control, and one of it is, you know, where we need to make certain that regulators consider provisions for a harbor provision, safe harbor provisions that will facilitate tough legacy contracts. So these are some of the things that we need to look at. Whereas on the other side, you know, we regulators also need to start firming up the date. I know 2 or 3 years ago, when I think Zakeli, when you and Bafundi said we'll start announcing in 2025, I said, why so long? And you know, I can't believe that it's going to take such a long. But now it's a year away, you know, and it seems, Richard, as if we don't make a definitive. Put down a definitive date, you know, people don't take it seriously. And hopefully today we can put that message throughout the day.
I 100% agree. It's a critical message. It's a fine balance, but it's the critical message to land.
I'm looking at this table and everyone is looking down, so clearly no one wants to make eye contact. It's fine. Oh, okay, here Parin wants to add.
Fantastic. Good morning all. Hopefully you can hear me well. Look, I think it's absolutely right to say that the way the MPG has progressed is we want this to be market-led. And I think that's important if you think about the global context. As Richard mentioned, we've seen 2 different approaches. We've seen one where you've had very active communication from the entire industry led by the central bank, which I think is the model that we're following in SA. I also think that market participants have the opportunity to really see purpose behind what is the work that is being undertaken here. And what I mean by that is if we look at the depth of the South African financial system relative to many emerging markets, we probably rank at the very top. Now, we can approach this in a disharmonious process, or we can unify, get this done, so we can actually focus on the more important things around building our economy. And I think if we take that purpose-led approach as an industry, as a collective, without, you know, hopefully never having to see the stick come out from the regulator, we can preserve, if not build, on the depth of our financial market. Thank you.
Thank you. Maybe to bring in the buy side, Jill, because there's been quite a heavy involvement, I suppose, from the banks pushing for this thing, and there's been some of, you know, people from some asset managers as well that have been part of the MPG and the work streams, setting up these targets and then also coming up with market conventions and what products would be necessary. But maybe let's start with maybe money market funds, for instance, because they often benchmark their performance against SAFE, which includes quite considerably a heavy element of JIBAR in it. How should they be thinking about this transition? How should we be thinking about, you know, performance attribution and maybe also investment strategies as the adoption of ZARONIA accelerates and JIBAR-related activity declines over the transition period?
So I think to start, in the money market, one doesn't index track. So if you take STIFI, it's a non-replicable index, and you don't, you know, specifically in your portfolio assume that you have to have X, Y, and Z in 3, 6, and 9 months. We're not talking about, MSCI indices for equity funds. We're talking about just a performance index. And I think sometimes performance indices get a life of their own without people realizing what they are. So it was instigated by Alexander Forbes. It was after index tracking began. It began in the other markets in the early 90s, but it was started by Alex Forbes, but they're no longer involved. Over time, as the cash market evolves, we will find another index will develop. We do have an opportunity to think very clearly what we mean by a benchmark. Theoretically, it's got to be something which is less volatile than the universe of assets. So there's a possibility, for example, of using fixed rate deposits as an input into these indices, because they reflect conditions in the money market. So I don't think we need to be too concerned about having to go and find a 3, 6, and 9 month rate that replicates STEFI. We can find something else as the market evolves. One of the questions that has been raised is that in CISCA funds, do you need to poll your participatory unit holders if you change the tracking index? Because to go and poll all these fund holders or unit holders just because you change your index from STEFI would be quite challenging. Fortunately, unless you specifically reference STEFI in your supplemental deed, you don't need to do this. So that means that we've got much more flexibility than we thought we had initially. I think that gives perspective. I don't know if they're practitioners, ex-practitioners. Richard?
Yeah, happy to share a view, but I think, Jill, I agree with what you've said, right? STEFI being non-replicable is a key point, right? And we have an opportunity here as an industry to look at something else. You mentioned the history of STEFI going back, I think it was in almost 25 years ago when Alexander Forbes introduced this index. We moved from something else before that to STEFI, and the market adopted it. It took time. Similarly now, same what we're talking here, JIBAR, Zeronia, the same applies to the investment industry in my mind, to say, we've spoken about STEFI for so long, we're now going to have a new rate that becomes the reference rate, and we'll get there, we'll move to it. And whatever needs to be done to get there, let's understand what it is and let's do it as quick as possible. But, to the point, I think there's various options we could consider as to how do you construct the new STEFI. The idea that you mentioned of using fixed rate NCDs, I think that's a great idea. You've got daily pricing, daily liquidity, you've got a commitment in liquidity, easy to replicate. And it shadows, to an extent, what you've already got with STEFI, right? So I think I fully agree with all you've said.
Thank you. Talking about an opportunity to look at something else, the other issue is suffix overnight, right? Which is used in the derivatives market. So we know that you discount portfolios, you use JIBAR, but to remunerate collateral using suffix overnight. How will that work in the new regime?
Yeah, it's a good question, Zakele. And I think when we think about the derivative market, we need to break it up. We need to think about the cleared market versus the uncleared market. So as it stands now, the cleared market, as you said, discounted JIBAR, remunerate collateral based on SAFEX. And really that all goes through LCH in terms of the clearinghouse. What is likely to happen going forward, and I think it's very likely, is that we get that change away from SAFEX to Zeronia on a cleared basis. And I think that's something that, again, we need to be prepared for. We need to think about from a valuation systems perspective in the industry and get ready for it. In the uncleared market, it's a bit different because there you've got a market that is, well, as I said, it's uncleared derivative market that is based on the underlying rate that is specified in the credit support arrangement, so the CSA. And whatever the rate in the CSA that is specified, that is what's used to discount as well as what's used to remunerate collateral. And so there I think it's going to have to be on a bilateral basis as to how do those CSAs get updated in time. But you could have this uncomfortable dual period where you have some being discounted at SAFEX, some being discounted at Saronia, until such time as you have full implementation or switch over to the new regime. So yeah, I think there again, some work to be done, but the market will move in time.
All right. I want to see if we can squeeze a question from the audience, if there is any. Please go ahead, sir.
Hi, sorry, can you hear me?
Yes.
So I'm just going to go back to the point about liquidity. I think one of the things that could actually help our market to improve liquidity quite quickly is if we could have MPC meetings into the future. So my question to the sub is it possible to always publish MPC dates at least 1 year ahead into the future? Because in that way, you should be able to code bigger volumes in much quieter, tight bit of spreads. So if we move from September meeting, we already know what the next date for the next September meeting is. If you get my question.
So
There's a
Are you
gentleman
talking about the
who's
start
looking-
MPC?
talking about MPC dates, so
Dates.
that on a forward-looking basis.
Yeah.
This actually came up in the work stream.
Yeah.
And exactly that. This is a suggestion that is going forward on that. But David, maybe you want to go?
It so happens this has been mentioned by a couple of people recently, so I've been looking into it. The issue for us is that we haven't really pinned down the MPC calendar until earliest sometime during September. And we really don't want to be in a place where we put out all these dates and then the governor gets invited to go and, do some important global event, and suddenly you've got an MPC calendar that's been set in a year advance, and so then we change those dates, and then that change would probably be disruptive for everyone. So we haven't been able to figure out how we can do it as early in advance as people have been asking us to do. There is a sort of active project at the moment to see if we could move it any closer, because we know there's a very short gap from that November MPC statement where we published the dates, and then the January MPC meeting is just 2 months later. But I think moving it dramatically earlier is just going to be very hard, because we just don't know the SARB's calendar for the year that far in advance. Thanks.
So the suggestion that is going to come through is that every time after an MPC, you announce the next date. So you're only predicting one date ahead and not the full 12 months. So we don't give a full 12-month calendar ahead. We're only just updating 1 month. So we always have 12 months of dates at a time. But that is something that the SARB can reflect on and see if it is possible or not, taking into account what David has already said. Okay, maybe to wrap this one up a bit, Zafar, you started to talk about some of the issues earlier on that could potentially affect this transition. Are there critical issues that could potentially derail the transition plan?
Yeah, I did speak about the safe harbor provisions. So those are some of the things that probably are out of our control, because the legislation needs to pass, and that takes, takes quite a process. And I think Richard alluded to a few things as well. But let me rather talk about one or two things. Well, one thing in particular that we observed from the overseas markets that had transition is communication. And as Richard has said, if you look at the audience now compared to our previous, there's certainly much more interest. And for some strange reason, and you were part of the study group, Zakelia, that went to quite a few regions. I mean, the regulators, the Financial Sector Conduct Authority and the equivalent in the UK, the the central bank and so on, and in the US as well, were surprised that at the very end, people said, we don't really know about it, we didn't think it's going to be so okay. So communication is of utmost importance. And so my plea is really, or the MPG's plea is to make sure that we speak to our clients and all market participants, because the MPG can certainly not reach each and every part of the financial system. So communication is essential, and as well as some of the other things that Richard mentioned. So let me just give that one point. Thanks.
All right, sure. And then maybe on that communication bit, what is the FSCA planning on doing? I know there's then the DSCO letters.
Yes. So indeed, the FSCA, together with the Prudential Authority, through the Joint Markets Working Group, compiled a draft DSCO letter. So the purpose of this is to communicate the authorities' expectation to ensure that financial institutions, senior executives and boards understand the risks associated with the transition, and are taking appropriate action so that financial institutions might transition to alternative rates ahead of the JIBAR cessation. And we have mentioned, like I've mentioned in the previous presentation, the importance of proper planning that will ensure that relevant business units and supporting functions execute effectively, and then also the importance of a comprehensive risk assessment of the potential prudential and conduct risk associated with the transition. So we've mentioned the risk assessment before, and also the proper planning that should be done. So hopefully the letters will go out soon to the CEOs.
Sure, we'll count that as your last word for the day. And maybe I can give Jill and Richard an opportunity if you've got last thoughts that you want to convey.
It's too early in the morning to have last thoughts. There's a lot ahead of us, so no, not at this stage.
No, for sure. And you're coming back also in the panel later on today. And Richard, you're going to be giving a speech.
Yeah,
or
I'm
responding
giving a presentation
to
later as well, so there'll be a few other angles and elements that will be introduced.
All right. Maybe you can offer the audience one if there's a burning question, and then we can wrap it up. Please.
It's related to the earlier question. In the absence of FRAs, forward-starting single-period swaps will essentially be the instrument to be used in the market to try and express interest rate views. In which case, I agree with the other question in terms of the availability of MPC dates, and it is potentially quite important then for the market.
Okay, that's a comment. I hope Rashad did take note of it. Okay, he's written it down. All right, thank you so much to my panel. It's been lovely. I will hand back to you, Delisile.
Okay.